what's going on. Okay.
We don't want to hate and despise one another. In this world there's room for everyone, and the good earth is rich and can provide for everyone. The way of life can be free and beautiful, but we have lost the way. Greed has poisoned men's souls, has barricaded the world with hate, has goose-stepped us into misery and bloodshed. We have developed speed, but we have shut ourselves in. Machinery that gives abundance has left us in want. Our knowledge has made us cynical, our cleverness hard and unkind. We think too much and feel too little. More than machinery, we need humanity. More than cleverness, we need kindness and gentleness. Without these qualities, life will be violent, and all will be lost. The aeroplane and the radio have brought us closer together. The very nature of these inventions cries out for the goodness in men, cries out for universal brotherhood, for the unity of us all. Even now, my voice is reaching millions throughout the world. Millions of despairing men, women, and little children, victims of a system that makes men torture and imprison innocent people. To those who can hear me, I say, do not despair. The misery that is now upon us is but the passing of greed, the bitterness of men who fear the way of human progress. The hate of men will pass, and dictators die, and the power they took from the people will return to the people. And so long as men die, liberty will never perish. Soldiers, don't give yourselves to brutes, men who despise you, enslave you, who regiment your lives, tell you what to do, what to think, and what to feel, who drill you, diet you, treat you like cattle, use you as cannon fodder. Don't give yourselves to these unnatural men, with machine minds and machine hearts. You are not machines, you are not cattle, you are men. You have the love of humanity in your hearts. You don't hate, only the unloved hate, the unloved and the unnatural. Soldiers, don't fight for slavery, fight for liberty. In the 17th chapter of St. Luke it is written, the kingdom of God is within man, not one man nor a group of men, but in all men, in you. You, the people, have the power to create machines, the power to create happiness. You, the people, have the power to make this life free and beautiful, to make this life a wonderful adventure. Then in the name of democracy, let us use that power. Let us all unite. Let us fight for a new world, a decent world, that will give men a chance to work, that will give youth a future and old age a security. By the promise of these things, brutes have risen to power, but they lie. They do not fulfill that promise. They never will. Dictators free themselves, but they enslave the people. Now let us fight to fulfill that promise. Let us fight to free the world, to do away with national barriers, to do away with greed, with hate and intolerance. Let us fight for a world of reason, a world where science and progress will lead to all men's happiness. Soldiers, in the name of democracy, let us all unite!
Size, shape, how sharp it is, the pointy bit at the end, or is it in the skill or intent of the person who wants to use it? When does a knife become a sword? And by the same token, when does an innocent-looking home loan or credit agreement become an instrument of financial mass destruction? A weapon capable of holding entire countries to ransom. That's what we're here to talk about today. Specifically, what I want to go through today is I want to go through this document. This is a document we put together at the New Economic Rights Alliance about a court case which we're going to be shortly filing. And it exposes some rather interesting stories about what the banks have been up to. There are 16 points. Shouldn't take too long. Relatively simple. Point number 1. Banks do not loan money, as their prolific advertisements claim. Money loaned is actually money created via an elaborate scheme of paper shifting and number crunching. It can be said that banks make money out of thin air under the pretense of a loan, but in reality it is not a loan at all. This is deceptive and misleading, as very few South Africans know the truth. When you go to a bank and you take out credit, that credit did not exist before you took it out. There was no money loaned. Point number 2. Crap. Point number 2. Crap. Who are you? I speak for the audience. We believe you are talking crap. No, this is not crap. Yes, it is crap. Scott Tata. Excuse me? It is nonsense. It is not nonsense. And my name is not Scott Tata. My name is Scott. S-C-O-T-T. Scott Tata. Okay. You don't believe me? No, I do not believe you, Scott Tata. Fine. Evidence. This is a quote from Graham F. Towers, Governor of the Bank of Canada. Each and every time a bank makes a loan, new bank credit is created. New deposits, brand new money. Secretary of the British Treasury, Ralph Hawtrey, said, banks lend by creating credit. They create the means of payment out of nothing. 14th edition of Encyclopedia Britannica goes on to state that banks create credit. It is a mistake to suppose the bank credit is created by the payment of money into banks. A loan made by a bank is a clear addition to the amount of money in the community. Our own director of the South African Reserve Bank, Stephen Goodson, stated in a recent article, did you know that commercial banks create money out of nothing and lend it to you at compound interest? And moreover, they insist that you pledge real assets for such loans. Let me repeat, banks make money out of nothing. The Federal Reserve Bank of Chicago published a workbook entitled Modern Money Mechanics. Outlines precisely how the money creation process works in banks. Deposits are merely book entries. Transaction deposits are the modern counterpart of bank notes. It was a small step from printing notes to making book entries, crediting the deposits of borrowers, which the borrowers in turn could spend by writing checks, thereby printing their own money. Believe me now. Look, see? Okay. Internet crap. It's not internet crap. This is real stuff. Internet rubbish. Just because I find it on the internet doesn't mean it's not real. However, here's a court case. In the Credit Rivet decision, a bank manager, this is a court case from America, admitted that all money or credit which was used as consideration was created upon their books. And this was standard banking practice exercised by all banks. Right. Yes? Starting to understand what's going on here. Right? More proof. I'm going to hammer this home today, guys. This is one of the most important concepts in banking that we need to understand. That when you go to a bank, the money does not exist. It gets created mysteriously for you.
My dear friends, I'm an accounting professor from the University of Economics and Business in Vienna, and I started speaking very openly about deficits and problems in our monetary systems in October 2008, just after the crash of Lehman Brothers. It was a public discussion. On my side was the former Chancellor Franz Wranitzky, and he was really shocked. Most people don't understand the problems that we are facing. And perhaps you know Venus Project, you know the Free World Charter organization, you know perhaps the books and the stories of Gene Roddenberry, Star Trek, where we live in a world without money. I can tell you it is possible. But the problem we are facing is how can we get there? And all that we have to know is it happens in our minds. We have to push the right switches, and then we will find the path. I will give you some hints and clues how to do it on yourself. First of all, what's wrong with our money? Most people seem to believe, okay, is not a positive value. Money is invented by the banks. If you go to a bank and you get a loan, they don't give you money that lays around in the vaults of the bank. The bank that gives a loan doesn't have the money. Loans from banks, this is money that doesn't exist. It is created. It is created by lending it out, bearing interest. And this is one of our major problems today, because when banks grant a loan, the money doesn't exist beforehand. It's not existing. It's invented out of thin air, but then, in fact, the banks want it back with interest, and this is the problem, because they never invent the money for interest. In the beginning, in older times, some 1,000 years ago, people used cattle or sheep as money, and then, if they lent a herd, they returned it with the newly born calves, and this is what we call natural interest. Natural interest grows on itself, and then we can return it. No problem with that. But if we use gold coins or paper money, they don't get children. So banks only create the money of the loan and never the money to pay interest, and this is where the problems start, because the money for the interest doesn't exist in our money volume. So this is the root of the so-called competition in a real economy. We have to fight against each other, to take away money from each other, to give it back, to give it to banks as interest. Yeah? Back is the wrong word. So, you know and you understand that our money that we use today doesn't have any value in itself. It is completely worthless. It is funny paper, numbers, bits and bytes in the computers, but still we treat it as if it were gold coins. And this is the next problem that we face. Because banks demand a collateral from their customers. They, on themselves, they have nothing of value. They offer you bits and bytes and paper sheets. But then they take away your house, your car, your property, if you don't give them back the money with interest, where the money for the interest has never been invented. Now, if we can't repay the capital, we lose the collateral, and this is what we call expropriation. You know it from the foreclosure problem in the United States today.
Just out of interest, before you came here today, how many of you didn't know that? I'm interested. Okay, how many of you did know that? Most people. Excellent.
You told us.
I told you. Good. Well, I discovered this, and it still took about 6 to 8 weeks before the penny really started dropping. And that's why I want to really hammer this home, because it's an incredibly important point. And also because it leads into deeper stuff that goes on behind the scenes. Unless you get this part of it, you're not going to get the rest. Okay, now, he mentioned that this concept that when money is loaned, there is an interest factor, but because money gets created without allowing for the interest, it means that we're going to be put in a perpetual cycle of competition. Cycle of competition, yes. What else? Death spiral. I like that. Slavery. This is essentially what's happening. Okay, now what's interesting now in the Earl of Katniss, in the speech of the House of Lords, said, our whole monetary system is dishonest. Really. As it is debt-based. We did not vote for it. It grew upon us gradually, but markedly since 1971, when the commodity-based system was abandoned. What do they mean by commodity-based system? Gold standard. Back in the days when notes and coins actually had some resemblance back to the asset or the real tangible thing of value, gold, silver, etc. And this was reduced. I believe in South Africa it was 1980, anyone? Something? 82. 1982, around there. So, essentially our money's just become debt. Now what they're trying to say is every cent in existence at the moment of all money is debt because it has to be loaned into existence before it exists. Okay, now it's a little bit like this. Let's say I have 200 Rand. I've got a 200 Rand note. And I want to lend that 200 Rand to 10 different people. So I make 10 photocopies of that note, and I lend you all 200 Rand, and I expect you to pay it back with interest. Ding! Something's not right with the system. Now, what your conventional, many of your conventional economists will say is they'll say that, yes, but you see the economy has to keep cycling in order to keep paying it back. Exactly. It's called the tread. What is that wheel the hamster goes through? It has to keep going. And what happens is it means economies have to do what to keep alive? Expanding, exactly. So what happens is the less they expand, the worse it is. And when they stop expanding, I think China's up to, what did I hear? One of the major industrial sectors is down for 8 months in a row now. When you're talking about a massive economy that starts growing or deflates, the exponential size of that economy means that the smaller the reduction in growth, the more cuck it's going to cause. You see what's happening? Because of this. Now, a lot of people will talk to me and say, well, financial crisis this and financial crisis that. It's not going to happen in our lifetime. Let me tell you this. There's only 2 words you need to say to anybody who says this is not going to happen in our lifetime. 2 words. Exponential curve. That simple. We are hitting an exponential curve of note. And it's really starting to hit home. What I'm going to do now is I'm going to show you a bit more because I still want to harp on this because the fact that money is debt, I want to also start introducing you to how the money is actually created where it starts getting really interesting. But for now, it's absolutely important that you get this fact. Okay, that money is created out of nothing. A credit facility is very different to a loan. However, what do the advertising and the advertisements of the various banks claim? What is that? A loan. Okay, and I'm going to show you how the difference between a loan and a credit facility is. But for now, I'm going to show you
Bank of England and found some quotes in here that really sort of cast light on the process. This first one here. The money-creating sector in the United Kingdom consists of resident banks, including the Bank of England, and building societies. So that's an unusual term, money-creating sector. You know, most people would assume that only the Bank of England can create money, yet here it says that, you know, UK banks and building societies can create money as well. I needed a bit more confirmation, so I kept reading. By far the largest role in creating broad, that's digital money, is played by the banking sector. When banks make loans, they create additional deposits for those that borrowed the money. So when banks make loans, they create additional deposits for those that have borrowed the money. And for those who aren't familiar with banking jargon, deposits are the numbers in your bank account. Okay, so Paul Tucker, second in command at the Bank of England, confirms this again with the phrase, banks make loans by simply increasing the borrowing customer's current account. That is, banks make loans by creating money. I thought, you know, that this money came from some pensioners, like my grandmother, who's been saving up her entire life, and that it was lent to young people to buy houses. But he's saying that banks make loans by creating money. If you need further confirmation, this is Martin Wolf, the chief economics editor at the Financial Times. Should be a fairly credible source. Now, Martin's actually also on the Independent Banking Commission, which means the government respects his opinion enough to ask him what should be done to fix the banks. And he quite recently said, the essence of the contemporary monetary system is the creation of money out of nothing by private banks, often foolish lending. So how does this process work? How do private banks create money out of nothing by lending? Well, I don't want anybody to panic, but there's something you need to know. There is no money in your bank account. Absolutely nothing. Your bank account is not a safe deposit box. It's not a box where you can put your money in and then expect them to keep it safe. Unless we're talking about a Swiss safe deposit box. Are there any exiled dictators or drug dealers in the room? No. Okay, so let's assume that everybody here uses a normal electronic bank account. When you put your money into the account, you lend it to the bank. You know, it becomes the legal property of the bank, and in return you get a number in your account which says that the bank will repay you at some point in the future. So this, your bank balance really is not the balance of the money in your account. It's a record of what the bank owes you. It's what the bank needs to repay to you at some point in the future. Okay, so your bank balance just shows you how much the bank owes you. It doesn't mean there's actually any money in your bank. And this is true, there probably isn't much money in the bank. In fact, so right now, this is going from Bank of England figures that were about a month old. If we all went back to the bank today and said we want our money back, then the bank could repay roughly £71 for every £1,000 in your account. And before the crisis, that was even worse. Before the crisis, they could repay just £12.50 for every £1,000 in your account. So there is no money in your bank account, and there probably is no money in your bank either. And you can see 69 here. This yellow line at the bottom here is the total amount of cash in the economy. This green line is the money created by the commercial banks electronically. And this red line is our total debt to the banks. Now this has just got completely out of control over the last 20 or 30 years. You can actually see that the debt that we owe to the banks now far exceeds the money that we actually have in the banks. So if we...
Exponential curve. There was a great professor who actually said that he wishes if there's one thing he could teach the world was the power of the exponential curve. How's that? Sorry, we're losing you. Was the power of the exponential curve. Just imagine you went to a pet store. I noticed someone like cats. The cat walked in just now and he got very excited. Just imagine you went to a pet store and you said, "I'd like to buy a goldfish." And you bought and you went into the pet store.
You just need to go and can you just grip them?
Can somebody just
Thanks.
He's just... How's that? Is that all right there at the back? No? Yes? Okay. All right. Just imagine you went into a pet store and you went to buy a goldfish. And the pet store owner says, "Right, what kind of fish would you like?" So you have a look around and you choose, and you want a fish that's obviously gold, but you want white stripes and a few little silver specks on it, etc., etc. And you choose the goldfish you want. So then what you do is you go home and you take a goldfish with you, set it up in the tank, and everything's fine for a few days. Then you start looking at this goldfish, and the goldfish starts to flicker. And you start thinking, this is like weird. Goldfish aren't supposed to flicker. What is it, some Monsanto fed fish or something? What's going on here? No, what you start to realize that it's actually flickering because something's wrong with the electronic circuitry. It's not actually a real fish. It's a holographic simulation of a fish. So you're a little bit miffed. You go back to the pet store and you say, "Listen, what the hell is this? I asked for a real fish. I wanted a real fish." And the pet store owner says, "Well, hang on a second. Let's look at the agreement. It meets this criteria. It has the silver specks. It has the white stripes, etc., etc. It fits the contract. We have an agreement. What's wrong?" No. I want a real fish. No, but what's the difference? It still does exactly the same. You didn't even know it wasn't a real fish until something went wrong. So what difference does it make? It makes absolutely no difference to you. As far as we're concerned, we have an agreement. It's not a real fish. Now, for some people, they're okay with that. Because the counter argument is always, you got a house, or you got something of value. Agreed, you did get something of value. But first of all, did you really? When we start going into the deepness of this, I'm going to get you guys to realize something. If you've paid off an entire asset, there is a legal possibility that you can still lose that asset even though it's fully paid off. Why? Because the rights to that asset were sold behind your back in the so-called credit agreement. You can all gasp now with dismay. Okay. Now I'm going to talk a little bit about, although it's been repealed now, the Usury Act of 1968. It's interesting here. It says the Act refers to a money lending or credit granting. Or credit granting. A money lending transaction or a credit transaction. When we talk that, we just assume they're the same thing, don't we? Money lending, credit granting, what's the difference? There's a huge difference. But we never taught this stuff. The parties, money lender and borrower, or credit grantor and credit receiver. Money lender and borrower, or credit grantor and credit receiver. But these distinctions between them are never identified and they're never defined. In fact, it even says a money lender or credit grantor shall, within 14 days, deliver or send through the post to the borrower or credit receiver a duplicate or true copy of the instrument of debt. Instrument of debt. What's an instrument? Instrument is something you play with an audience. Instrument. Again, words that are being used are not necessarily the same meaning in legal and banking terms. They sound the same as they do in everyday. A duplicate or true copy of the instrument of debt was so executed. A duplicate or true copy of a document which has been signed by the money lender and borrower or the credit grantor and credit receiver. Are we starting to see the difference between a credit, extension of credit, and a loan? Right, in a loan, I take something out of my wallet and I lend it to you. It's a physical movement of something. In a credit extension, the money goes bing and just appears. This is what is starting to, shall we say, cause a few ripples within the financial economy, and what are the main reasons why you guys are here today. Now it goes deeper. Walker F. Todd was called in as an expert witness in the US case, Bank One versus Harshavardhan Dave and Pratima Dave. He is an attorney and former officer of the Federal Reserve Bank and recognized expert in the history of banking and financial instruments. His affidavit was made to the court on December 5th, 2003. In his affidavit, he stated, banks are required to adhere to generally accepted accounting principles, GAAP. GAAP follows an accounting convention that lies at the heart of the double-entry bookkeeping system called the matching principle. It must record offsetting liabilities that match the assets that it accepted from customers. The bookkeeping entries required by application of GAAP should trigger close scrutiny of the applicant's, the bank's, apparent assertion that it lent funds, credit or money. He's even stating in an affidavit that we should check out these banks really carefully because they're not actually loaning money. What he's referring to is very simple, to keep it very simple. You've got two sides of a ledger. You've got assets and you've got liabilities. The bank gets an asset worth a million rand and creates a liability for 1 million rand. In other words, the credit has just been created in a book entry. That liability, as you saw just now, if a bank owes you money, that's exactly the same as cash in your bank, money in your bank. There's no actual cash in your bank account, only the promise that a bank will pay it. Pay what? Nothing, because there's no gold left. So all that exists in your bank account at the moment are promises to pay. Now, if you give the bank a written promise, and you literally write, I promise to pay my bank 1 million rand, that's money. It's an asset. On the one side of their books is an asset, on the other side is a liability, which means they have to owe money. And owing money means credit advanced. Are you with me? Okay, so what has actually happened is your loan was created by nothing more than a bookkeeping entry. Again, it says, the bookkeeping entries required by GAAP should trigger close scrutiny of the bank's apparent assertions that it lent funds, credit, or money. Goes back to this word loan again. Most of the funds advanced to borrowers are created by the banks themselves and are not merely transferred from one set of depositors to another set of borrowers. Do you know how few people in banks actually know this? They honestly believe that banks are lent from deposits? I mean, wasn't that taught at school? Maybe they haven't updated the textbooks in 50 years. But we're teaching our kids that their banks borrow money at a small interest rate, what they pay depositors, and then they loan it out at a higher interest rate. That's their business model. Nothing could be further from the truth. So something's changed in the last few decades, but nobody's bothered to tell the people, and the people carry on operating on this assumption, which means the banks have got carte blanche to open in an entire new world. Among other things, that new world is called the derivatives market. 20 times larger than the gross domestic product of the entire planet. And it's riding on the back of our credit agreements. No lawful money, gold, silver, and official currency notes, was or probably ever would be dispersed by either side of the covered transactions. It remains to be proven whether the bank has incurred any financial loss or damages. Read that again. It remains to be proven whether the bank has incurred any financial loss or actual damages. If they haven't incurred a loss, why are they coming after real assets? Why are they coming after homes and cars and businesses and literally ripping money, salaries out of bank accounts? This is how bad things are getting.
Is it because banks are effectively trading in an insolvent position because they are lending money, they take my money, they lend to someone else who's actually higher risk maybe, and they end up multiplying it the whole time. They effectively are trading in an insolvent position because the assets are worth nothing.
It's actually, that's partly true, but it's actually way more to do with the fact of what's going on with the securities behind the scenes, which I'll get to shortly. It's mainly because of derivatives. If you carried on that model, the banking system, in my opinion anyway, as a non-expert. By the way, guys, disclaimer, this is all for education purposes today. Okay, I'm not a lawyer or a banker or a professional of any kind, so please don't take any of this as legal advice or try any of this at home. Although I really, really would like you to. Okay, I'm going to get into a bit more about that afterward, a bit later, but you really need to understand derivatives first, which we're going to get into, and mortgage-backed securities. Okay, David Friedman, in his book Money in Banking, reiterates that when a commercial bank makes a business loan, it accepts as an asset the borrower's debt obligation, the promise to repay. All right, when you go for a credit transaction, you take out a loan, you have to promise to repay it, right? You sign a document that says, I promise to repay this amount, right? That piece of paper is the promise to repay. That becomes the asset on a bank, of a bank. Okay, that's what they're referring to here. So when a commercial bank makes a business loan, it accepts as an asset the borrower's debt obligation, the promise to repay, and creates a liability on its books in the form of a demand deposit in the amount of the loan. Therefore, the bank's original bookkeeping entry should show an increase in the amount of the asset credited on the asset side of its books and a corresponding increase to the value of its of that asset on the liability side of its books. This would show that the bank received the customer's signed promise to repay as an asset. Thus, and here it is, monetizing the customer's signature. Where do banks get their money to loan from? Can't hear you. Us. We are actually the ones responsible for creating our own credit. But because we don't know how the system works, we're under this completely false illusion that interest rates are set by the government and the Reserve Bank, and it's designed to make the economy float. Go back to sleep, everybody. Everything's fine. It's all cool. Oh my goodness. Okay, I'll read that again just to make sure. This would show that the bank received the customer's promise to repay. And the promise to repay is an instrument, by the way. Those little pieces of paper is an instrument. It received the promise to pay as an instrument, thus monetizing the customer's signature. We are creating our own credit, and we have to pay it back with interest. And should we miss the odd payment, we get taken for a ride. And don't start bringing out the debt counseling argument. Because although in theory the debt counseling argument, and there's some great debt counseling, and what they're doing is hugely positive to in terms of what's happening, the banks are completely ignoring it. They're even ignoring debt counseling. Why? Why are banks so eager to foreclose? Why do they want to take all our assets away? Something is going on behind the scenes, and we need to find out what that is. But in essence, what is happening is here. I like to look at it as this. There's no real currency left. There's no gold or silver. So what we really have is funny money. Okay? So banks lend out ha-ha-ha money. That's what I call it. Ha-ha-ha money. That's what credit is. It's ha-ha-ha money. The reserves that they're supposed to have, in terms of cash, I guess, is also funny money, isn't it, really? Because banks are supposed to have a percentage ratio, let's say 10%. So they keep 10% as a reserve, and they loan against it. A lot of people believe that if a bank gets, let's say they get a million rand, right? They then have to keep 10% of it, which is 100,000, and they can loan the other 900,000 rand out. It doesn't work like that. What they do is, if they get a million rand in deposits, they're not going to touch that reserve. They only have to have 10% as their reserve, which means they lend out 900,000 rand on top of it. So they don't lend out the money they've got, so their reserves fall. What happens is they lend over the top of it. Now there's a great Australian economist who put it so beautifully when he says this concept that banks take reserves and then lend it out is nonsense. What actually happens is it's the other way around. Banks do whatever the hell they want, but when they need liquidity and they need reserves, they just phone the Reserve Bank or whoever and they just add liquidity. So opposite's the other way. Banks aren't determined by their reserves. They just ask for new reserves whenever they want it. Why? Because what are reserves? Ha-ha, money.
Why would they need that if they can create it without having the reserves?
Well, good question. The law says they need to have those reserves in place. Remember, what we're dealing with is a very convoluted, as Michael Tellinger would say, deeply, deeply convoluted system that goes into, it's quite secret, but at the end of the day, all this is governed by very, very strict rules and regulations, most of which the banks are breaking, many of which. Like, for example, this. If you go and ask your bank, and you tell them, I went to the seminar, and this guy, Scott Kundle, told me something that's absolutely outrageous, that there's no, actually, you never actually loaned me money. And all your advertisements say, you loan me money. Standard Bank's got a huge billboard in Joburg. I don't know if they had it here. 75 billion rand in home loans. That doesn't even come close to corresponding their end-of-year financials. That's not reflected on their financials. Where did they get these loans from? How can they put that out yet it doesn't reflect in their financials? Interesting. Where are these assets? What's going on? What's happening? Weird. And you saw the exponential curve the English guy showed on the screen. And you can start to see the discrepancy between the amount of interest that we have to pay back versus the actual original loans. Issues are happening, and we need to start getting this. Now, the Usury Act, again, remember it said, a money lender or credit grantor shall within 14 days deliver or send through the post to the borrower or credit receiver a duplicate copy of the instrument of debt, a duplicate or true copy of a document which has been signed by the money lender and borrower or the credit grantor or credit receiver. So, we know that they're not money lenders, so they are credit extenders. Now, modern money mechanics. Banks, this is a really interesting book for those who, it's very bland, but it shows you how our entire system works. It's called Modern Money Mechanics. Banks do not take security for any loans or mortgages. Now, this is really important. This is one of the reasons why, I know you all put up your hands before that you said that you know that money is created out of thin air. What you need to know is what really happens. Now, listen to this again. Banks do not take security for any loans or mortgages. Have you guys put security down for your loans or mortgages?
Yeah.
Houses or whatever.
sounds like a conflict there, doesn't it?
Yeah.
Okay, listen really carefully. Listen. Banks do not take security for any loans or mortgages. The credit beneficiary or nominal borrower, that's you, the borrower, pledges his security as a guarantee of his performance. In other words, as security for his payment obligations, not as security for the credit or loan granted by the bank.
Say it again.
Banks do not take security for loans or mortgages. The credit beneficiary or nominal borrower pledges his own security as a guarantee of his performance, i.e., as a security for his payment obligations, not as security for the loan that was granted by the bank. Technically, this is very important from the bank's perspective. Yes, I'm going to show you how this works.